You might be missing out on free money from your employer and not even realize it. Hi, welcome to Cash with Ash. I'm Ash, your hyper-fixated finance bestie. Today, I want to talk about 401ks and employer matches. Quick note before we get into it, I am not a financial advisor. This is just what I've learned through my own personal education, so please consult one if you need to. A 401k is essentially just an employer-sponsored retirement account. Sometimes you'll have two different options within the 401k of either a normal 401k or a Roth 401k. The typical average 401k is going to be where you can input pre-tax dollars, so you don't pay taxes on the money that's going into the 401k account. That money grows tax deferred though, so as that money grows, you take that money out during retirement, that's when you'll have to pay taxes. A Roth 401k, you're putting that money in post-tax, so you've already paid taxes on it as soon as the money goes in, but then it grows, and when you take it out in retirement, you don't have to pay taxes on it then, because you've already paid taxes for it when it went in. 401ks also tend to have higher contribution limits. They can change year to year, and if you're 50 or older, there are additional catch-up contributions you can make, so make sure to check the IRS website for what the current contribution limits are. Often with a 401k, part of the employer benefits package will have some sort of 401k match. The amount of money that your employer will put into that retirement account as long as you've put also a certain percentage in. For example, if your salary is $100,000 a year, you have a 401k match of 4%. This means that if you put 4% of your salary in, $4,000 over the year, your employer will match that $4,000 with another $4,000, meaning that at the end of the year, you would have doubled your money in your retirement account to $8,000. Employer match does not count towards the contribution limit for the year, so if for this year it was $20,000, you could put $20,000 of your own money in, and then that $4,000 that your employer put in would sit on top of that money. There's also sometimes things called vesting schedules that an employer will implement where there's 0 time before the money becomes 100% yours that they've invested versus sometimes there is like a stepwise at the first year, 33%, second year, 66%, so on and so forth until the money becomes 100% yours. It's really to incentivize the employee to stay with the company for a decent amount of time and not just leaving and being able to take all that money with them. I were to have a 401k benefit where there was a certain percent match, I would have my contributions at least at the minimum to get that full employer match before thinking about what other financial and retirement contribution decisions I'd want to make. Because remember, hot girls aren't leaving free money on the table.